Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
And this week, we're going to talk about underwater homes and the freaking 50-year mortgage. So we're going to start with the underwater homes because it's kind of some new emerging information. We don't talk about underwater homes a lot. You don't hear about it a lot, but here it comes again, like
not like
rearing its head.
Underwater.
I was just going to say, you know how we don't have room to build? It's a whole new community underwater.
This is not a flood and insurance conversation. So houses that are upside down on their mortgage, and then we'll eventually get to the 50-year mortgage thing. I really only want to talk about that today because we need to be able to talk to people candidly about like what is it, why are they proposing it, share some other variables, and then honestly admit like this is a bad idea.
Yeah.
So let's start with the underwater part.
Yeah, let's go.
Okay, so a new report from MarketWatch came out, says that approximately 900,000 homeowners, or 1.6% of all borrowers, are underwater on their mortgages. So they owe more than their home is worth. And the lion's share of this, of course, is people that bought their house in the last couple of years when not only prices ran way ahead of a normal appreciation, and interest rates also crept up at the same time.
Yeah, I like that you bring up the appreciation because obviously we saw 2020, 21, 22. I mean, we were seeing in some areas where appreciation was like going 20, 30%.
Ridiculous.
And it was just crazy. That's when we were seeing offers actually getting submitted with $100,000 above the asking price. You know, appraisals wouldn't come in. People are like, who cares? I'll pay 100, 150,000. I just want that property. It was crazy.
Yeah, remember the social media pictures with like 50 people like wrapped around the sidewalk just trying to get into an open house? And I mean, even here locally, some, 50, 75, 100 people at an open house was normal.
Yeah.
And they were overbidding by, tens of thousands or $100,000 in some cases. So I'm not totally surprised that this is happening. I'm not concerned about it either. I think I should put some context. So, these are still borrowers that are vetted in our new way of underwriting.
Yeah.
This is not underwriting from 2006 and 7 that then caused 2008 and 9 collapse at hand.
Yeah.
There's a much different set of variables on the financial side that are qualifying people for still being able to make their payment regardless of what the house's value is. When it comes down to it, this is all about whether or not the people can still be making their monthly mortgage payment.
That's what I was going to say. I feel like this is like the not so golden handcuffs that they bought. Yeah, they're able to afford the payment, but now they're underwater. The house is, worth less than what the mortgage is. So I think a lot of it had to do also, and I think they mentioned that the high leverage loans when they were coming in with like 100% financing, all that basically, affects the way that the equity grows. So that right there didn't grow as it was expected or as they wanted it to.
Yeah, no, it's just the article, the headline, right? 900,000, 1.6, homeowners. If you really put it in perspective, when we saw the mortgage meltdown, it was like 19 point some percent in comparison. So
it was like 1 out of every 5.
So, exactly. So that's really different. And then what's cool about this is you really got to consider the metropolitan areas where they're discussing this. So we're seeing a lot of those homes, like Florida is one of them, Texas, especially Florida. We're seeing quite a bit of that. That's because they're building condos. So we're seeing condos. They usually come with all these headaches when you have an HOA involved, who you can actually rent it for, can't. And so a lot of these people, I'm guessing that that's a lot of why we're starting to see, that metropolitan area go down. And being part of this discussion.
I think another part that's not mentioned in here is the migration to those places has slowed down significantly. Now, on paper, you might be inclined to, well, people are still moving to Texas. People are still moving to Florida. Yes, but not at the same rate that they were in 2020, 21, and 22. So yes, hundreds of thousands of people, if not millions, have still flocked to other areas outside of California, outside of New York. Let's be honest. Mm-hmm. They're leaving California and leaving New York, okay? And they're going to other places. You guys, I was in Idaho for a long weekend, and I talked to one of my friends who moved there 2 years ago. They just got a brand new truck. They went to the DMV, and he asked the lady across the counter, how many cars have you registered over the summer? And she goes, in June and July, we registered 46,000 new vehicles.
What?
Oh, 46,000 in June and July together. Wow. This last summer in 2025. Now that's less than what they did in 24 and 23. She goes, so it sounds like a big number, but it's actually slowed down. I'm using that as an anecdotal evidence of like, yeah, this might be happening in places, but because the migration to them has slowed down, not stopped, but it's slowed down, it's meant that there's a lot less places to buy because the people who are living there aren't selling.
Yeah.
So the existing inventory isn't necessarily there. And it doesn't surprise me, anything that does hit the market that is longer on listing time is eventually going to drop its price.
Yep.
And then when those things close, it makes new comps that then causes these houses to be underwater.
Yeah,
So
exactly.
it's like a second, third, fourth order effect of other economic pressures at hand.
No, absolutely. And again, it's nothing to be alarmed by. We saw drastic numbers in the mortgage meltdown back 2008-9. That's when everything was going. A lot of people were actually buying homes at that time, and it was considered to be underwater, right? You bought at the peak at 2008. It's like, why are you doing that? Again, everything is longevity with time. Like right now, if you consider that, they look like freaking geniuses for buying that. And that's because they looked at that buyer, looked at that this is as a long-term thing. If you're looking at a short play within 2-3 years, it may not be beneficial to buy something right now thinking that you're going to get, you're going to get a lot of equity based on the current market conditions. That may not be the factor in some regions, metropolitan areas. It's not going to pertain to every area. I feel very confident here in San Diego, and the reason why I continue to invest in my own backyard is because I understand the data.
Yeah.
And I see that the valley, I see that we're landlocked. There's many indicators there that I feel like we're a little safer, even if I bought at 100% financing, because as an investor, I want to go to this investment with as little money as possible. And so that's why I still take a risk here. And there's we know a lot of other investors and homeowners that buy in it, and they're very happy with it.
And I'm glad you mentioned that the difference is that it's not all across the board the same. Because I had a client that said he wants to cash out refinance, and then he's like, hey, down the line, am I able to do it again? And I'm like, given in San Diego where we're at, I'm confident your house is going to continue to go up in value. So down the line, if the equity's there, you could 100% go back and cash out again if the money's there. And it just goes to show different markets are going to perform at different ways. And I think San Diego's, we're lucky enough to have a strong market.
Well, and the other thing to consider here, San Diego, being that the Navy, we have one of the second largest military presence. They normally go in at 100% financing. So I know the article discusses that people who are, just pretty much over leveraged because they're buying with down payment assistance or buying a home with no money down. We just got to consider that and have that discussion with them. Is this going to be a home that you're going to live in for the next 5 to 10 years? If that's the case, San Diego is going to be a good benefit for you. If it's within a year, you're thinking you're in a PCS, a year, 2 years, maybe you want to just hold off and then rent, right? We don't want to just say, yeah, it's a good time and buy. You're not going to be underwater. No, if you're going to buy with the intention of holding long term, you're in a good place. And those are the things you have to really consider. Year, 2 years, if you're not thinking about that, it's like, I would say just stick with renting.
Thank you for saying that. I wrote down long versus short. This is really going to come down to what is your time frame that you're personally looking at for how long you're going to hold this property. Yeah. Whether it's your, and I think there's also another segmentation of this. If it's your private residence versus an investment property. So the other thing I'm writing here is you got to really discern the difference between the cash flow and the property value.
Exactly.
If you got cash flow positive, and it's okay if it's underwater for a little bit. Now that sounds like, oh, that's a stupid risky move. It's probably a bad investment. Again, go back to the time frame thing. Is it long or short? You're trying to make a short investment for a year or two, then that's more of a flip.
Point.
That's not a long-term hold. If you're trying to build a portfolio over 5, 10, 15 years, then it kind of doesn't matter because over the course of time, on a long enough time frame, we're not going to be having this same conversation about your place 10 years from now, 15 years from now.
Yeah.
So everything's within context, but look long versus short and think cash flow versus price.
No, absolutely.
Yeah.
It's a great way to break it down.
Yeah. So I'm not concerned about this either. I'm glad you said, hey, this is like not a big deal. I think that the perception is that because our most recent fallout was so catastrophic that it's like, oh my God, foreclosure numbers are going to go through the roof. And people, look, a bunch of people got homes that couldn't pay them. We have a bunch of people that are qualifying for these homes, even with no down payment, low down payment assistance that are under way more stringent guidelines on repayment and DTI and all that kind of stuff. Not totally concerned about this unless the economic shoe drops jobs-wise and income-wise. Then we have a problem.
Yeah.
And that's still about the payment, not even about the house's value.
And again, I mean, at the same time, these things do matter. It's good to start seeing where the indicators are, right? If you're looking and you're going to be, getting transferred to Austin, Texas, that's one of the things that they discuss here in the article. You may want to maybe I'll hold off right now, or maybe I will buy because I'm going to be there for a long time. I might as well take advantage right now when there's such a large amount of supply, where now I can actually go in there and negotiate the best terms and conditions for myself. So, and then also to put it in perspective, it's only 1.6%.
Yeah, that's what threw me off.
It's only 1.6%. I mean, it's just like, whoa. When they put 900,000 homes, the psychology of things, seeing that large number is like, whoa. But really consider it when we're over 350 million, Americans population wise, right? More or less. So it's like, it's not a lot.
It made me laugh. I was like, oh shoot, that's a lot. And then 1.6. Come on, guys.
It's true. But it just so mentally you kind of think about that, and it helps you understand. So it's always good to have information and read into it and, know your data.
Yeah. No, this is good. I want to pivot and go right to this whole 50-year mortgage thing, guys, because, this kind of came out at the beginning of November. It was making its way through a bunch of different talk channels in mortgage and real estate and finance and business. And, so, in case you have not heard it yet, there was this idea floated about looking at 50-year mortgages and the debate over whether or not that helps affordability or if it fosters an increase in price and locks in our interest rate environment, et cetera, et cetera, et cetera. My initial first comment to set this talk up is, number one, for a long time, 2 and 3 years ago, we kept saying to everybody, when the market slows down and rates go up, the banks are going to get more creative on ways to continue lending money. It's like water. It has to be moving so it doesn't become stagnant and bad and dangerous and toxic. So the money has to keep flowing for them to stay in business. Now, you can love or hate banks, separate comment, but you got to keep lending money in the lending game. That's the game. The other thing is that we were expecting, because the Fed was projecting that we would be in a much lower rate environment now, based on where we actually are now. So by the time you got to the end of 2025 and the beginning of 2026, our projected rate decrease by the Fed's dot plot chart was supposed to be a lot lower than where we're at. Yeah. So now that we have this kind of mix happening, well, here comes the market again with another creative solution, because the other variables are not playing well together. Yeah. You still have mostly elevated and unaffordable total home prices. You have median home price that's gone up. Interest rates are, say, stubbornly high. Inventory has been getting better, but still historically low. So we have these competing variables, and now the solution is, well, let's just go do 50-year mortgages, and I think that's a bad idea. Let's talk about it.
Well, I mean, let's start with the history of things, of how everything was developed. When we go back to prior to the Great Depression, and we want to talk about the creativity, how everything goes, right? So prior to the Great Depression, there was a 30-year mortgage, but it was all interest only. Right. And so there wasn't a 30. I'm sorry. Let me retract that. It was a 3 to 10 year fix only, interest only payment. So you're never paying down the principal. And then it was a balloon payment at that 3rd or 10th year. So you had to pay it off. You better have saved up that amount of money. I know it seems like, well, you're buying a house at 10,000, at 20,000. It seems like less
numbers now. Yeah.
But if we really look at, exactly. If we equate it to what it is now, that's pretty crazy, right? So pretty much like right after the Great Depression, banks had to come back and be encouraged to lend out money. And that's when in 1934, the FHA was actually created. And then in 1938, Fannie Mae was also created there. And it was all made up so that consumers can get a cheaper and safer loan. They're protected, right? That's where the whole escrow accounts came about and all that good stuff. And so, again, it encouraged banks to go out there and lend. They wanted to do this because they wanted to stabilize the housing market, because back then, people were losing their houses. Yeah. All Americans, the majority of Americans were losing their houses. I mean, it was crazy. And then, it wasn't until the 1950s, 1960s where the 30-year mortgage became the standard. And then that's what it was, right? And so at that time I'm going to go back to the 1938 and stuff. That's when finally mortgage payments reduced your principal. That's when the fully amortized begun. Like, let's give the advantage back to the homeowner, the buyer, so they can pay these things and not making a balloon payment. So we've been practicing this that many years, and now we want to go with the 50-year, and so our William Polk decided like, hey, let's go with the 50-year mortgage. I think that sounds good, and obviously the administration is going to say, yeah, let's encourage that.
Okay, so there's a lot of look at me, I'm already rubbing my face like, oh, it's painful. I do not agree, but I am saying I understand why they would offer this up as a solution. Yeah. I get that they think it solves the affordability problem. Downstream from that, though, there's already economic evidence from other countries that have done this without the success that is claimed at the beginning when it's suggested. So suggested solution sounds great. Let's do it. And then a decade, 2 decades, 3 decades later, guess what? It's actually not as promised.
Yeah.
Much like a lot of other things. Ding.
Yeah.
So I do not like this idea because again, I feel this way about other things. I'm going to say like socialism and communism as well. It's like, oh, we're just going to do it different. You're calling it the same thing and you're expecting a different result. I'm not sure what you're talking about.
Insanity. No, it's definitely a solution, but I feel it's more like of a Band-Aid that really just covers up the actual issue, which is lacking of housing supply. And at the end of the day, it goes right back to that. I mean, you can come up with all these solutions. It is a solution. They're coming up with creative ways to, bring affordability down, but it's really just masked with, with the real issue of saying, hey, we don't have enough houses for people to buy. And that's really what's putting the price on the pain on the prices.
I mean, let's take a look at this. Who really benefits from this?
The bank.
The bank. Realtors, because if you lower the payment, you make it more affordable for people, more people are going to jump in, right? And so what causes, we go back to the 2020, 21, where now there's bidding war. So who's going to benefit? Realtors now, the banks are going to be making that interest. Wall Street. Right? We're going to Wall Street. We're going with other investors that are going into this. And so builders, although they're giving incentives, right? They're going to make their money somewhere else. Who really isn't going to benefit?
The consumer.
Exactly. It's the
homeowner.
It's the homeowner.
At the end of the day, I'll pay 50 years of interest.
And what's happening is the homeowner is going to be he's going to be a renter for the bank. It's going to, the landlord's going to be your bank.
Basically it.
Yeah. The intention is that
borrowing it.
It would create, just like we, and look, I'm going to take a page out of our own book, but this is a different cat. Okay. We talk about generational wealth and we talk about legacy building all the time here. When you buy real estate, you hold real estate, you pass on to your kids. That is one of the things that they say you can do with a 50-year mortgage. Oh, you get a 50-year mortgage, you at least own a place that you can pass on to your kids. What you're really doing is passing down to them a ton of long-term interest to pay. Now, people are like, well, why aren't you this angry normally around 30-year mortgages, Andy? Well, because for the last 70 years, it's been our only way of making affordable payments until now. So that's why.
And even sometimes like that is tough, right?
Because that's a lot of interest too. You look at a $750,000 loan, you're paying hundreds of thousands of dollars of interest. Yeah. Well, you're going to pay even more than that when it's 50 years long.
Well, let me bring you to that. Let me give you that because I like examples. I like numbers, right? And so what I actually did is I went to an example and I did a loan amount of $340,000, and we're talking about at a 6% interest rate. Okay, on a 30-year mortgage. After you're financed at $348,000, it's going to cost you $403,117. Okay, that's the standard. That's what we're all used to right now. It's like I'm almost paying double for this. Now, if we go with the 50-year, check this out. The interest only is going to be $751,113. That's $350,000 more for that same home that you're going to pay.
So that's triple paying almost.
Yeah. Triple paying.
That's crazy.
So, as we see a 30-year mortgage, you're going to build wealth. You're going to be debt-free in 30 years. Whereas the other one, I'm going to be 80, 85 years old, blowing out the candle on my birthday and still own a home.
So own a mortgage.
I still have a mortgage.
Hey, when he's 85, it's going to be like an AI digital candle. You're not blowing out nothing.
No,
it's like
exactly.
Graphic pixels.
And Andy, I do love that you mentioned other countries that tried this. Actually, Japan was one of the ones that tried this back in the early 1989 or so. Their economy was booming. Their housing market, their houses were worth far more than ours here. And that's because they started this type of financing. Yeah. So what they were doing was creating generational debt traps for their kids. Those were traps. They would just kept getting them going for many years. I don't want to do that to my children.
Yeah.
Yeah, no, I don't want to do that either. And
Or
you're right.
grandkids.
It's your grandkids. Yeah, no, we want to do the opposite. We're talking about is we want to have homes that they can take back and that they can be the receivers of, and they can be granted to them, and they can be good stewards of it from there. I don't think this is a good financial solution long term. It might solve a short term problem, but what if again with 20 years, what have we seen with short term solutions?
Yeah,
they're short term and they work for a very short period of time, and they're a problem for the rest of your life.
They're a problem for and just like Brian said, it's a temporary Band-Aid, you know?
And one of the arguments I heard, and I want to get your guys' thoughts, is somebody was mentioning, talking about the 50-year mortgage, and they're like, well, yeah, we get it's a 50-year mortgage, but if you look at it from a point of leverage, you don't have to stay in that mortgage for 50 years.
You don't.
You can refinance, but a lot of people don't understand that concept because it's like getting in debt. When I'm already in debt, you want to refinance at a lower rate or at a better term. And although that might sound appealing to some, it's not that like strong solution that's going to be carried out and help us get to the promised land and fix every problem.
Listen, this is going to be the greatest generational wealth transfer because of the baby boomers.
Yeah.
Guess what? Who has their houses paid off?
The baby boomers.
And that's to show you, if you see people that actually pay off their home, they have a ton of equity and they're better off financially. They're not asking like, hey, my kids, take care of me. They got their own ways and their own means to take care of themselves.
Yeah.
And that's why that's the greatest transfer of wealth there's going to be.
Yeah. And I just think it's, like, why would you want to pass down debt to your family? Like,
unless you want to keep up with the Joneses and you're always just, hey, the want is always going to supersede the need, right? And you're just going to continue to go out there and spend and cash it out and use the house as a piggy bank. I mean, you're entitled to it. Go ahead.
I almost think like
we're here to finance it too.
So here's the crazy thing. It's like, why are we jumping from 30 to 50? Why don't we do 35 years?
Yeah.
Or 40 years? The market can obviously create a brand new bundle or a brand new bucket of money if they want to issue bonds for a certain time frame that connects to this. Why are we jumping from 30 to 50?
Yeah,
it just seems like really aggressive to go that direction. I don't like it. And I think that there's a better solution still.
Yeah.
Because yes, even though ahead of us a generation is the greatest wealth transfer known to mankind, it actually has to transfer and then translate. Yeah. It's fine if it transfers to me, but if I'm under a heavy debt load and I inherit $500,000 from my parents and I have $500,000 of or $751,000 of interest on my 50 freaking year mortgage, I've still netted nothing.
Yeah,
right. So you can generation transfer something to me, but that doesn't mean I actually have it to use. If I just, I'm sorry, I'm not shortcutting. Oh yeah, you could pay off your mortgage. Yeah, you could do that. But the point is, if you are not a recipient of that, you don't have that choice. Yeah, you don't get that luxury.
Well, here's the thing. There's already a 40-year mortgage out there. It's non-QM. Right? Yeah, which doesn't conform to the regular Fannie Mae, Freddie Mac, Ginnie Mae guidelines and rules.
Interest rate.
But the rate's higher, right? And it's made more for an investor that's looking like, I don't care about paying off the property. All I care is about the cash flow. So how do I generate the cash flow, right? I'd rather go on a 40-year interest only, right? But it's going to be interest only for the first 10 years and get amortized over the next 30. So his goal is, let me see what I can do in the first 10 years. As rates go down, I'll be able to refinance and then I'll put myself on a 30, but most likely people will do that. Okay. The other thing to consider that we didn't discuss is when I compared that, I compared it at 6%, right? So you got a 30-year at 6% that I compared a $348,000 loan, but we already know if we increase the duration, what happens to the interest rate?
You pay more.
Exactly. So if your interest rate's now not 6%, it's even 6.5, 6.6.
Buddy, that's a lot more hundreds
You're really,
of thousands.
so in my example, I forgot to mention, it was going to be about a $200 and some difference in payment a month going from a 50 to a 30, right? So if we consider the same rate, it's only going to be less than $100. Where's the benefit?
That's so terrible.
Benefit to
Where's the benefit?
That's so terrible.
No benefit to, you get a lower payment, but we just broke it down. It's not really
exactly. Because right now we have a 10-year. We can do a 10-year fix. We can do a 15-year fix. We could do a 30-year fix. And we're already on the 10 and the 15 interest rates are usually about a 1% lower than the 30 than the other. So therefore it's like, okay, but now if we go to the 50, holy moly. If it's right now a 1% different, let's just imagine what's going to happen.
Yeah. I just think this spells trouble. I don't see, like, I have watched conversations leading up to this conversation today on both sides of this. I understand why the advocacy feels the way they do, that it could work. I don't like the long-term effects still. So you can still tell me, yeah, it will work. Sure, but it's still temporary. Historically, it's temporary. Anecdotally, we've seen that it doesn't work long-term, and it shackles people with more debt for a long period of time. It's going to stifle home prices or make them increase. So again, more inflationary pressure upwards on appraised value of homes, which then is going to lead to more people having to get 50 than being able to do 30, and then on and on and on and on. Right now, the cycle spun up, and here we go.
Yeah, for me, this doesn't solve the problem. It doesn't solve low inventory. The market doesn't magically get better because the financing terms change. And bottom line is, we just need more inventory. It's really it.
But at the same time, it's going to diminish the inventory for sure.
Yeah, we're going to need more, even more, because more buyers are going to be approved.
Home prices are going to increase again, and it's just, you're just going to pay a lot more for that home.
It's like going to be a good 3 months.
And then in San Diego, when you're talking about $1 million home,
yeah,
right? I'm going to pay almost $3 million for that.
Do that for San Diego. Crazy. Oh my god.
Yeah, people might, again, they're going to buy a place in the city they love, but you're going to die here. I don't know, guys. Anything else on this one? I don't have anything else to add. I feel like I ranted loud and hard for long enough on this one.
I mean, as you can see, we try to discuss the pros and the cons, right? The pros are that you're going to have a minimal payment.
Yeah.
You can. The cons, I think, outweigh the pros in this situation. 100%. I just don't think it's fair enough for us to create a generational debt trap.
I think this is a
American nightmare.
American nightmare. I think there's a word I'm thinking of. I feel like this is an act of desperation.
It's not like a Hail Mary.
One of the very first things that came out when the new administration was get affordability in check. And they charged the housing agencies, they charged the Fed, they charged the markets via the banks to some degree. All this new money coming to the United States via tariffs, all this bond activity, like what we want people to be investing in United States treasuries. If enough of those things aren't working in concert together, you do something like this. That's what I think is ultimately happening. Is this is the result of those things not firing off as good as they were hoping they would.
Yeah. But you have to, right? We're driven by our real estate.
Yeah.
I mean, what other country can you go to and get the same type of financing that we're currently having? What other country are you going where you're seeing the appreciation of such?
Yeah.
This is, we're an economy that's driven by real estate.
Yeah, and there's tons of international investment in our mortgage-backed securities and bonds and all that kind of stuff.
And that's
Treasury.
diminishing.
So then I was just telling Brian right before, but they're cycling out of that too, man. They're starting to look at other stuff. And it's like, oh man, here we go.
Flat for since the Fed.
So I
even lost too. Maybe
act of desperation is what I'm summarizing here at the end. I think this is an act of desperation. I don't see it another way.
I agree.
If you have a comment you want to share, teach, or show me something, please tell Uncle Andy something different and make him smile. I got this frown over here. I think I'm furrowing my brow for the last 15 minutes straight.
You might be growing some hair too.
I don't like feeling this way, guys.
No, you know what? I'm glad that you're saying that, Andy. Tell us what your feedback. Are you for a 50-year mortgage? And if you are, tell us why you're for it.
Let us hear your side of it. Yeah. If you want a 50-year mortgage, tell us you do, and then tell us why. Explain to me so I can understand your perspective. Why is this an advantage to you? Maybe this could be the only way you get in. I'll hear that.
Yeah.
It doesn't change the consequences downstream, but I'll hear that. And I'll take one quick story.
Yeah.
I had a friend of mine, he bought a franchise about 9 years ago. And I said, hey, I don't mean to be insensitive, but I know you overpaid for the franchise. And it took a dip of revenue for year one, 30%. And he said it was my only way to get in. And now it's way up 9 years later. It took some time, but he's way up, and it's a franchise, so it makes money. It's not an expense, it's an asset. A house is an asset and expense at the same time with a mortgage. But his attitude was, it was my only way to get in. Yeah. I was either going to get in then, or I would not have an opportunity to get in at all. And so I get that. I'm just saying I get that.
I agree with you. However you want to get in. Get a piece of, a land that's going to appreciate, but also do your due diligence of where you're going to buy that piece of land. Yeah. There's some places where it's stagnant. It's a depreciating asset. I'm sorry to say, is just what it is. The rents don't match, what you would you buy a home for. So it's like, just consider your pros and cons in every situation that you're in and you're looking into buying. So due diligence, data is key. And now we have so many tools. We have so many people that understand that. Like the numbers, the math doesn't lie. Just grab that data.
Yeah. Any final thoughts, guys?
No.
No, that's it.
That was a fun article.
That's it. All right. Well,
50 year was great.
Hey, if we got to bring that one back again and like go over it, that's great.
Yeah.
I hope we don't have to talk about underwater homes again. I mean, that's fine if we do, but I'm mostly confident that it's going to be connected mostly to income, and those will not turn into foreclosures. It just happens to be like right now. Check the pulse. Oh, okay, we got some underwater homes. No big deal. Long term, I hope not. And then the 50-year mortgage thing. Let's see where that goes. Here's the other thing. I didn't say this earlier, but let's say that solution is just rejected publicly and privately. Then what?
Yeah.
Back to the drawing board.
Then what are they going to do? Because all these other pressure points that aren't working in the favor of what they're hoping to have the outcome be, and you got to come up with something else.
We're going to have to figure it out.
Curious about that.
Yeah, absolutely. We're going to continue to discuss underwater homes. It's going to happen. This is something that's going to happen. History always repeats itself. And so we're going to see more homes, because of everything with AI, seeing these companies, there's going to be a lot of job replacements. There's going to be people who will ultimately, I don't want to say underwater, but it's going to be difficult for them to pay off their home.
Hey, what if they did the 50-year mortgage thing, which helps secure price increases and appreciation and takes all these underwater homes out of it. Dang it. That would be a double whammy show topic. The one saves the other.
One saves the other.
All right, guys.
You're done.
Thank you for a great show. Thank you all for watching Mortgage Heroes Weekly Podcast. We're so glad that you join us every single week. And guys, hey, I didn't thank you for covering for me when I was gone. I got to go out for a long weekend in Idaho. It was wonderful to spend some time out there. It was very great. So thank you for covering the show. You did a great job while I was gone. And thanks for having me back. You weren't like, hey, we don't need you no more, guy. That was cool
Although
too.
We're trying to save money to send you to Turkey.
Oh, wow. Get him out of here altogether. Get this guy. Hair growth. Give him some hair growth and come back with a brand new head of hair.
I get it.
All right. Well, if you don't get it, go search the internet.
Yeah, there you go. It's there.
Go search TikTok or X.
Yeah.
Thank you guys for joining us. Remember to like this video, subscribe to the channel, turn on notifications so you catch every episode every time we release one. And we had an amazing, amazing interview for Friends of Mortgage Heroes that you're going to be able to see once this airs. You're going to be able to watch that show on Friday of this same week. So you're going to meet our friend Eric, who has a amazing and beautiful resort down south from us. I'm not going to say anything else but the name O2. Okay, O2.
Yeah. And I have to drop Rich Summers right there, though.
Rich Summers, thank you. You're an encouragement to everybody. And I cannot wait for y'all to watch Eric's story about building a resort in wine country in Baja. It is beautiful. Yes. All right. Thank you all for watching, and we'll see you again next week.
See ya.
So if you enjoyed this video and got value from it, subscribe right here. And if you want to watch another video, click right here.